Meridian VAT Add-on is a modular solution built directly within SAP to handle complex VAT determination within the system. Today we're going to be looking at our sales module. The sales module is used to cater for complex VAT determination on business flows such as cross-border consignment flows, triangulation sales, drop shipments and chain transactions, etc., supply and install flows. The flow we're going to be looking at today is a triangulation flow. The flow itself, we have a Belgian entity selling towards a Polish customer. Belgian entity doesn't own any of the goods. Instead, it's going to buy them in from its principal entity, which is based in Germany. There's a lot of VAT rules that need to be understood before the triangulation exemption can be applied. So, for example, do we have 3 EU countries in the flow? Yes or no? Do we, as Party B, have a VAT registration number in the country of destination? Because half the EU countries would say if we do, triangulation cannot be applied. The other half would say that triangulation can still be applied if we are maintaining a VAT registration number in the country of destination. We also perhaps need to check to see if our customer is performing a customer pickup and picking the goods up directly at our German plant, because that again would affect the VAT determination. And probably one of the most important rules is that we as Party B need to ensure that our customer, our sold to party, has a VAT registration number in the country of destination so that they can perform the acquisition. Taking that triangulation can be applied. What we're expecting to see on this flow from a VAT determination perspective on the commercial sale is that it should be catered for as a triangulation sale reported in Belgium. On the intercompany sale, it should be reported as an intra-EU dispatch of goods reported in Germany. And on the intercompany purchase, it should be a triangulation purchase, again, reported in Belgium. So I'm going to take you now into our SAP system. And first thing I'm going to do is I'm actually going to deactivate the Meridian VAT add-on so we can take a look and see how standard SAP would treat this triangulation flow in the system. So I'm just going to delete our BE10 entity, and I'm going to save that. And I'm going to create that sales order now in the system. So it's for our Belgian entity, and it's towards a Polish customer. And we're selling standard rated goods, one piece from our German plant that our Belgian selling entity doesn't own. So the first thing that we can check is in the header of the billing document, we can see that the EU triangular deal indicator hasn't been ticked. This is because standard SAP doesn't recognize this as a triangulation flow. It doesn't understand the rules in relation to triangulation. But also if we have a look now at the SD condition record, so let's have a look at the analysis and we can see how standard SAP is trying to treat this from a VAT determination perspective. We can see that the tax departure country has been determined as Germany. Let's just go back and have a look now at our business flow. On the commercial sale, this should be determined as tax departure country Belgium. But what standard SAP is trying to do on the commercial sale is create an intra-EU and intra-community movement of goods. And it's going to try and do the exact same thing on the intercompany invoice. And as we know, 2 intra-EU movement of goods in a 3-party flow is non-compliant. It's not correct. The destination country Poland, it gets correct. The customer tax classification is 1 liable for taxes. Material tax classification is also 1 for standard rated materials. So nowhere here in the SD condition record that we see is there any indication that this is a triangulation flow, and it's also not compliant. So I'm not going to save this sales order. Instead, what I'm going to do is I'm going to go back and I'm going to activate the Meridian VAT add-on. So I'm going to put our Belgian entity, BE10, into our activation table. And I'm going to create that sales order again. So again, it's for our Belgian entity, just a standard order towards our Polish customer. It's 1 piece of standard rated goods from our German plant that our Belgian entity doesn't own. Now, if we check the header of the billing document, we can see that the EU triangular deal indicator is now ticked. This is because the Meridian VAT add-on is being activated. SAP now understands all of the VAT rules in relation to triangulation, has identified this as a triangulation flow, and has dynamically updated the EU triangular deal indicator. So the EC sales list will now be complete. If I check the analysis, we can see that the tax departure country has now been correctly determined to be Belgium. The destination country we set to EU. This is an important point because we have specific EU and XX logic. What that means is that you don't need to create your SD condition records towards every destination country. In the case of an EU country, it's simply Belgium to EU, or in the case of a non-EU country, it's Belgium to XX. We set the customer tax classification to T for triangulation dynamically. So from a master data perspective, you just need to ensure that your customers are either set to 1, liable for taxes, or 0, in the case of you're dealing with a truly exempt organization, like someone like NATO, for not liable. Meridian will then take over and where required will dynamically update the customer tax classification to further ensure we're getting the correct SD condition record. One of the points I said was that one of the rules in relation to triangulation was that we need to ensure that your customer has a VAT ID in the country of destination. If they don't, it's a non-compliant flow. Meridian has a blocking functionality so that if, for example, this rule is not satisfied, we're able to issue an incompletion log, which will allow the sales order to be saved, but the delivery will be blocked. So what I'm going to do is I'm going to change the ship to address to an address in Luxembourg. Our Polish customer doesn't own or doesn't possess a Luxembourg VAT ID. And we can see now that because this triangulation rule hasn't been satisfied, an incompletion log has been issued, and party C is not VAT registered in the country of destination. So I can set that back to Poland and clear the incompletion log. So we can see our document is now complete. So what we'll do is we'll do the delivery. This is where we're going to put the goods on the truck. And we're going to post that goods issue. Meridian's VAT add-on does a tax determination at both the sales order and the billing document stage. This is because these are the 2 points within SAP for sales, for SD, where a tax determination can be carried out. We do it at a billing document stage because we want to make sure that for the billing document, we're using the most up-to-date information in the system. We can see that as nothing has changed, we're still expecting to trigger our condition record for BE EU T1. So we're happy to save that now. And now we can go ahead and create the intercompany sale. So remember, for our intercompany sale, we're expecting an intra-EU dispatch of goods that's going to be reported in Germany. So we're expecting the SD condition record DE EU 11. And you can see that's exactly what we're triggering. So we're happy to go ahead and save that. Now let's go and see, based on the IDOC, what tax code was determined for the intercompany purchase. Remember, we're expecting here that this is going to be an intercompany repurchase reported in Belgium as a triangulation purchase. So let's go and check that intercompany sale. And we can have a look at the IDOC. And you can see we're triggering our Belgian tax code BT for a triangulation purchase within Belgium. So just to go back to our slide, you can see there for each leg of this triangulation flow, the Meridian VAT add-on is able to correctly determine the correct tax code to be determined for each leg.